Hello, thank you for tuning in. If this is your first time, thank you. Happy Friday. I hope you enjoy the number of series that we are posting about insurance in superannuation. If you know anyone who might benefit from these sessions, please feel free to forward and share so that we can build a community of people who might be able to help voice their opinion so that we can improve member engagement within this industry. Naturally, as I've posted a number of videos about insurance in superannuation, the feed that's coming through my YouTube account is also related to superannuation or the same topic. One that caught my attention is the one that was posted by Sunrise 5 days ago, which is the 13th of September. And the title of the video post was How to Save Your Super from Fund Fees. So you would have seen from the thumbnail that I used for this video, I screen captured the tips that they gave in that show on what you can do to save fees. And the one that they posted last in that list of tips was about switching funds. However, they did not mention the risk that that might create on your insurance cover. So I'm hoping that this episode will actually supplement that. If you go and watch that and come back and watch this, I think it will give you a reasonable understanding of what you need to think about if you are indeed looking to switch funds. So one of the most important things that you need to consider is understanding your insurance cover when you're leaving your fund and you're switching to another. And especially if you're only thinking about saving fees, because if you're not in a good state of health, you may not be able to get the same type of cover in the new fund that you're going to. So, for example, a lot of funds will actually impose what's called a limited cover. What that means is you will only be insured for new events or apply a pre-existing condition exclusion. New events is exactly what the word suggests. You're only going to be covered for something that occurs for the first time while you're a member of that fund. Let's put it in a bit of a context. If for some unfortunate circumstance you've got cancer, you had cancer, and you are currently in remission, and then you decide to switch funds, if that cancer comes back at a later date, you may not be able to claim under that new fund because you did not get or sustain that cancer for the first time while you were a member of that fund. Or another example would be multiple sclerosis. It doesn't happen overnight, right? That type of condition can deteriorate over many, many years. So at the moment, you might actually be okay. You're still working. But if you switch funds and then you deteriorate to a point where you're no longer able to work forever and ever, then you may not be able to claim because they might find that if it's got a pre-existing condition exclusion, it means that you sustained that condition while you're a member of the other fund. And therefore, you may have been paying premiums for nothing. Or your insurance will just not deliver at the time when you need it the most. So if I were to, the other thing, sorry, before I move on, the other thing is if you may have been underwritten for cover in your previous fund, and at the time that you had provided a satisfactory evidence of good health, you may have been in good health, but 2, 3, 4 years down the track, you want to move to another fund and you're not as healthy anymore. You might have diabetes, cholesterol, blood pressure, whatever it is. They're going to put either an exclusion or charge you more, which is negating the fee savings that you were getting in the first place by switching fund. So these are the things that you need to think about when you're switching funds, not just the fees, but also the insurance, particularly if you're not in good health and you've already got cover here. So if I were to wrap up in 3 main things, what you need to think about. A, you need to check your insurance where you currently are. Make sure you understand what you are compromising if you're switching funds. B, You need to get confirmation from that new fund what insurance arrangements you're going to get. Be honest. Make sure you disclose what condition you might have that might affect their decision to offer you that insurance cover. Okay? You don't want to lie to them, because at the end, you might be paying premiums and then it's not going to deliver in the end because they're going to deny it because of non-disclosure. And finally, before you even contemplate switching insurance, do your insurance cover first. Once you've decided that you want to switch cover from Fund A to Fund B, transfer that insurance cover first into your other fund. Have that negotiation with the new fund if they would take it on a comparable basis. And then once that's done, only then should you switch funds. Otherwise, you do your switching of your funds, your insurance will be cancelled without you getting an opportunity to negotiate transfer terms. What I mean by transfer terms is you speak to your new fund and you go, I've already got insurance in my current fund. And then they'll ask you details and they might be able to do transfer terms and try to match that as best they could. Make sure you raise this with your financial advisor if you have one. If not, feel free to ask me a question down below. If I can answer it, I will. Coming back to my disclaimers, I'm not a lawyer. I'm not a financial advisor. I don't work for an insurer, but I do understand some of the complexities here that most superannuation experts forget about, because they're very focused on investment most of the time, because it's a realized, tangible sort of benefit that you get in your superannuation, and they tend to forget about insurance. I'm sorry this went on a little bit longer than expected, but I hope I've delivered something that's worth, that you've got to take away from this. I look forward to seeing you again in the next video. Stay safe and see you in the next video.